Riddle. Which country recorded a growth of 0.8% between the first and second quarters of 2023, 4 times higher than France and much higher than Germany and the United States? The answer is unlikely. China. This country, which has been growing insolently for 30 years and aims to become a planetary and technological superpower, has been slowing down for 10 years and has been stumbling ever since the appearance of the virus. After the lockdowns, restrictions, tests, and vaccinations, China had not recorded such economic performance since the 70s. This news is good news for the West, which sees China's progress in defense, digital technology, and energy with a bad eye, as well as its rapprochement with Russia and its plans for monetary conquest. However, not everyone jumps for joy, because when the Chinese machine slows down, the whole world follows it. In this video, we will explain why this slowdown has implications for us and for the rest of the world, and try to find out what will happen and if it will last. Recap. It took only 30 years for China to become the second largest world power. Between 1990 and 2020, GDP per capita in purchasing power parity terms increased by 17 times, consumption increased by 42 times, and the annual growth rate fluctuated between 7 and 14%. This phenomenon is known as the Chinese miracle, which allowed the country to catch up with the West, legacy of Mao Zedong's isolationist reigns. This meteoric growth was made possible thanks to important reforms carried out at the end of the 70s. Deng Xiaoping's new government has encouraged economic openness, attracting foreign investors to promote technology transfers and encouraging the creation of companies. These reforms have helped to stimulate the manufacturing sector, and China has become the workshop of the world. Many foreign companies have invested in China to take advantage of an abundant and inexpensive workforce, thus strengthening the skills of the population and the competitiveness of made-in-China products on international markets. Major infrastructure investment plans, such as bridges, roads, ports, and airports, have also greatly facilitated trade and cultural exchanges in China and in partner countries, especially those located on the route of the new Silk Roads in the Middle East and on the African continent. Today, China exports its products, its cuisine, its applications, its billionaires, and its investments all over the world. It has hosted the Olympic Games twice in less than 15 years and counted 150 million Chinese tourists who visited the world in 2019, while it itself received nearly 30 million foreign travelers. China has become the biggest customer and the biggest supplier to millions of companies around the world, and that's why when the Chinese economy is doing well, everything is fine. However, from 2012, growth began to decline slowly to stabilize around 7%, although it remained sustained until 2018. Unfortunately, it was another export that China would have done well, with that put an end to this growth. A microscopic export independent of its control, a stowaway named COVID-19. 2019 to 2022, the inflection. Since the first alerts, we have all witnessed the coronavirus epidemic that has rapidly progressed around the world. China was the first country to take draconian and unprecedented measures to limit the spread of the virus, which led to an amazing and unusual silence. Factories closed, office workers were invited to telework, streets emptied, and shops remained closed for weeks. China has experimented with quarantine on a large scale by placing several major cities under close surveillance, such as Wuhan, Shanghai, and Beijing. The other governments of the world have followed China's example, which has produced surreal scenes everywhere. However, in April 2020, the restrictions were lifted and the country was able to resume its activities. Events have whetted Chinese appetites, and it was necessary to make up for lost time. Growth picked up again in the third quarter, and China was one of the few countries to have maintained positive growth that year, with a rate of 2.3%. It is a masterful demonstration of the responsiveness and effectiveness of government services and the zero-COVID policy. However, this period of expansion left deep traces. The real estate sector, which provided almost 40% of the country's economic activity for 3 decades, was the most affected. Builders, developers, architects, and real estate intermediaries have dominated the Chinese landscape, but have lost their way a little in their exceptional development. Risky diversifications and expensive investments have led to significant losses for the dragons of the stone. Cheap and easily accessible borrowed money also played a role in this crisis. Despite the government's efforts to clean up with its national plan to deleverage Chinese companies, it seems that the virus's resistance capabilities have been underestimated. After a period of relative calm, the coronavirus reappeared on March 19, 2022, this time in the largest Chinese business center in Shanghai. Half of the city was confined, then the whole 1 month later, causing the anger and exasperation of the population. For the rest of the world, this is a shock wave, and for China, a return to square one. In the second quarter of 2022, activities slowed down sharply and growth stood at only a small 0.4%, followed by a plus 3.9% in the third quarter quarter-on-quarter. However, the virus is still circulating and there are currently 5,000 victims per day, according to estimates by foreign observers. China refuses to communicate these figures transparently, but the problems it had to face before 2019, amplified by the coronavirus in 2020 and then by its reappearance in 2022, have now taken on unexpected proportions. Balance sheet. Let's take a look at the economic situation in China, which experienced growth of only 3% in 2022, well below the forecast of 5.5%. However, the second quarter of 2023 showed signs of recovery with GDP growth of 6.3% compared to the same period the previous year. The growth target for this year is maintained at 5%, but it should be noted that real GDP growth between the first and second quarters of 2023 was only 0.8%, which indicates a slow recovery. Premier Li Keqiang had already anticipated this situation during the Summer World Economic Forum in Tianjin. He also stressed that even with a growth of 6.3% in the second quarter, China remains below forecasts, which were 7 to 8%. In addition, he warned that the challenges facing China could still weigh on its economic performance this year. One of the main challenges is the real estate sector, which is still in crisis. This sector is crucial for the Chinese economy, accounting for a quarter of GDP and employing hundreds of thousands of workers. However, due to shortages of materials and difficulties in honoring their commitments, the real estate developers have not resumed the construction sites. Buyers, on the other hand, refuse to pay their monthly credit installments, thus aggravating the situation. To deal with this crisis, the Chinese government eased its debt reduction plan at the end of 2022. Forcing banks to grant special loans to real estate developers. Evergrande, one of the largest real estate developers in the country, has accumulated losses of $100 billion over the past 2 years and has a debt of almost $300 billion. To avoid bankruptcy, Evergrande submitted a restructuring plan to the authorities, which was approved and should enter into force next October. However, Evergrande is not the only player in the real estate sector in difficulty. The Standard & Poor's 100% Chinese real estate index continues to fall, and all Chinese real estate values are down. In 5 years, the total stock market value of companies in the sector has been halved. In addition to the housing crisis, domestic demand has also fallen due to the zero-COVID policy. Domestic consumption has almost quadrupled, and demand from the rest of the world has also decreased by 8.3% compared to the previous year. In addition, the youth unemployment rate has reached record levels, with almost a quarter of those under 25 without a job, which further reduces consumption. What's going to happen? Is China on the verge of falling into recession? To answer this question, it must be remembered that for an economy to be considered in recession, it must meet 4 criteria: 2 consecutive quarters of GDP decline, low domestic consumption, rising unemployment, and reduced investments. At the moment, China does not meet all these criteria. The social situation has not yet deteriorated sufficiently, and the decline in activity is insufficient to speak of a recession. According to the Chinese premier, this situation is temporary. Beijing is showing a growing interest in its economic situation and has already put in place a number of measures to restore balance. The government is still investing in infrastructure related to the new Silk Roads and in the modernization of its power plants, mainly powered by coal. The Central Bank of China has lowered its key interest rates and revised down the bond reserve requirements of banks to stimulate credit and revive demand. Government aid and national guarantees should stabilize the real estate and manufacturing sectors. Finally, the Chinese recovery should begin with the services, which are invited to continue their efforts and recruit with the support of the government. However, despite these measures, this year is expected to be the worst Chinese economic performance since the 70s. Many forecasters have revised their forecasts for 2023. Standard & Poor's lowered its forecast for growth from 5.5 to 5.2%. Morgan Stanley dropped from 5.7 to 5%, while the World Bank raised its forecast to 5.6% instead of 5.1%. In reality, Chinese growth has been declining for 10 years, and it will take some getting used to. The country has reached such a level of development that it is becoming incompatible with growth rates close to 10%. Thus, a growth rate of 5% will become the norm for China in the coming years. For the country, this is precisely the minimum level of growth required by government projects and investments. But for the rest of the world, what does this mean? This means that China will no longer be the engine of global growth that it has been in recent years. Consequences for the rest of the world. Until the Chinese economy stabilizes, Beijing will continue to prioritize domestic problems, even if that means changing its foreign policy. In its search for liquidity, China may have to protect its financial interest more, slow down investments abroad to redirect them towards national objectives, offer less flexibility to its debtors, or even demand early repayments of loans granted in the past. However, many fragile economies depend on China's largesse, such as Nigeria, Congo, Argentina, or Chile, and could encounter difficulties. The deterioration of relations with the United States and the war in Ukraine have also accelerated the attempt to militarize international trade. The BRICS, gathered around the Chinese leader, are planning to create a new monetary unit based on physical resources such as gold, capable of overshadowing greenbacks based on debt and questioning American domination. The BRICS Development Bank is in full swing, and this new monetary unit is scheduled for August 15th. In summary, Chinese economic activity disappointed strongly last year and is struggling to catch its breath in the face of a persistent virus. However, comparing the 5% growth of China in 1970 and those of China in 2023 is irrelevant. Today's China is a developed economy, the number 2 in the world, which is now turning to consumption and services. For 2024, Morgan Stanley expects a return to the average downward growth trend that began 10 years ago in China, i.e., 4.5%. The IMF predicts the same thing because the war could again weigh on the price of raw materials and degrade the markets of Chinese companies. Finally, Moody's joins the general life with 4.5% growth expected in 2022. So, should we invest in China? It is important to take into account the challenges that China is facing, such as the structural problems amplified by the crisis and geopolitical tensions. However, China remains a major economy with significant growth potential, especially in the consumer and service sectors. It is therefore important to carefully assess the opportunities and risks before making an investment decision. What do we do? If you hold Chinese stocks in your portfolio, it is recommended to keep them and monitor the Chinese markets in the medium term. The analyses are more optimistic and predict a strong return of the Asian markets. Chinese stock markets have experienced disruptions for 3 years, but they have been rebounding since the beginning of the year in anticipation of an imminent resumption of growth. According to Derletti, Chinese growth still has bright days ahead of it, thanks to the country's colossal foreign exchange reserves and the absence of inflation. At Carmignac, we believe that the Chinese markets once again offer a good starting point and that a targeted approach with active management is the most suitable strategy to take advantage of them. However, it is important to note that China is a complex market and that holding Chinese securities exposes you to currency risk and specific risks related to US sanctions. It is therefore essential to be very careful and remember that investing in stocks involves a significant risk of capital loss, regardless of the sector or region. If you are interested in major Chinese projects, do not hesitate to check out the videos we have dedicated to them. Also, don't forget to get an expert to accompany you before you start investing. Take good care of yourself and see you soon for a new topic. It was Money Vision.